I just wanted to talk a little bit about option spreads because I think I understand them. So first I'll explain what an option is in stock trading. Essentially it's someone really smart came up with an idea to mitigate risk. And essentially when you buy when you're investing long, which essentially means you will make money when the stock price increases, the total amount you can lose is the number of stocks you purchased multiplied by the market price, multiplied by what you purchased them for. And the total amount you can gain is infinite because the stock can go up infinitely. If you think about that, and if you're short selling, basically means you'll make money when the stock goes down. You'll only make money to zero, so you have a limited amount of money you can make, but you can lose infinite money. Because when you short sell, essentially you're dependent on having to buy those stocks back at a lower price. Because you owe someone those stocks. But there is a way to have limited gains and limited risk, and that's options. Essentially why it's called options is because it gives you options on when to buy. I'm stupid, not when to buy, but basically options because it's exercising the contract is optional. And futures is basically options except for exercising the contract is not optional. And forex is just foreign exchange. I don't know if it's like currencies or if it's other stuff, stocks. But basically for an option there's always a buyer and a seller. So when you buy an option, someone else is going to fulfill that contract for you. They're going to make up the difference so that the contract is valid. So if you buy a call, not selling a call or selling a put or whatever, or a spread or anything like that, if you just buy a call option, essentially what that means is that you can call on that option. You can buy a stock at whatever price, which was the strike price, at any time before the expiration date. So essentially, if you buy an option that says I can buy this stock at $20 before October 1st, then anytime up to October 1st you can do that. But you don't have to because it's an option. It's optional. And essentially, if the actual stock price is more than 300, you just bought it for less than it's worth. So, and the person who sold the option, they're hoping you don't ever exercise it because they'll have to make up the difference if you're buying it for less than it's worth. They'll have to buy it for 350 and then give it to you for 300. You'll only have made money if you purchased that option contract for less than $50. And all of those numbers are factored in when you sell options. You know, you have an expected risk, and the only time you make money in the stock market, the only time you make money selling or buying options is when you make a better guess than other people. That's why I'm not really a fan of it, because I don't really see myself as above average skill level and intelligence in stock trading and strategy and like business than the average stock trader. Not just the average person, but the average stock trader. I don't see myself as having a great advantage. So the amount of time and effort I'd have to put into it to maybe be above average would not be worth it. I would rather do something else with my time. And if everyone took that philosophy, then the only people in stock trading would be the best of the best. And the secondary market. So if people were smart, basically the only reason some people make money is because stupid people think they can when they can't. It's a neutral sum game, but actually really a negative sum game because of the overhead of actually doing the trades, running the computers, all that stuff. I guess you could also include negative sum for the society, because you have people doing things that don't actually produce things that aren't just numbers on a screen, like food, luxuries, things you can enjoy other than numbers on a screen. You can enjoy numbers on a screen, but I don't really consider that very satisfying, so it's not really a product to me. That's why I don't really like the stock market. But in a way, it has a positive effect because it allows very intelligent people to have a lot of money, which is generally a good thing because they can do better things with that money than other people. That doesn't mean anyone should be in poverty. Absolutely not. And some people use it as a rationale, but I like the fact that it enables people to do things. The primary market especially enables people to do things like Elon Musk. He wouldn't have his companies without the IPO he did, initial public offering, which is basically the only time buying a stock actually gives money to the company. And also, I just feel really uneasy about the prices of stocks if they don't have dividends or if the company is not going to do buybacks, which they never do. Because if like you're trying to buy a share in a company, you're basically saying, I'll give the company $500 and you expect to get $500 back over the course of the lifetime of that company in dividends, right? That's why it has an intrinsic value. But without non-dividend stocks, I get that the investors want the company to reinvest all of that money that would be going to them instead, so that their stocks are worth more to sell in the secondary market. But I just don't see how there's any actual causal direct connection between the company's quarterly earnings and whatnot, and the people actually trading, other than through their imaginations. So that's why I also feel really uneasy about trading stocks. Okay, I kind of got off on a tangent, but back to options trading. Essentially, you can think of it as insurance. You will never have to buy it for less than $300 if you buy a call option for $300 before the expiration date, and $300 is the strike price. But that person selling the option, they're in a short position because they hope that the option if it was at the money, they hope that the price of stock does not go up. And so think about this: if you buy a call option, let's say that the expiration date is immediate, like there's no time left. If you buy a call option for less than the actual price, let's say you buy a call option at $300 with 0 seconds left to expiration, and the actual stock price is at $350, that call option should be worth $50. So you should have to pay $50 for that call option. Doesn't that make sense? So but if that date is in the future by let's say a week, that gives more time, means more opportunity for that price to change. So if you ever look at extrapolations of stocks, basically it's a cone sticking out from the end of the stock. The more time, the farther that price can move. So basically it gives more opportunity for bad or good things to happen. But essentially that means if it's a out of the money option, essentially that has no risk to the person who's selling it. If you exercise it immediately, it has no risk if you exercise it soon. If it's out of the money, essentially that means it has no intrinsic value. Like selling a call option at $400 if the stock price is at $350. Why would you ever sell that unless the expiration date is crazy in the future and everyone has a good sense that the stock price is gonna go long? But if the expiration date was like a day from now, there's no way that the stock price is gonna jump $50 in a day. Most likely not. So the price of a call option out of the money is going to be really cheap, but you're probably never going to be able to exercise that call option and make profit off of it, because it's never going to go over, the actual price is never going to go over what you're allowed to buy it at. So you'll never buy it for less than the actual price. But if it's out like a year or 2 years, who knows what the stock's going to go. So the extrinsic value of a call option or an option will increase the farther away the expiration date is. And as you get closer to the expiration date, the extrinsic value goes to 0. So at the money options, their value is 0 at expiration. So that's why they decay in value over time. That's why if you try to sell your option, if you buy your option and sell it, and the stock hasn't moved and it's at the money, you're basically just throwing away money. And out of the money options are inherently worth less because there's a less chance that they'll get to that value. But they're extremely cheap, and you can buy a lot of them. So if it ever does go up, you don't have to pay a lot for that option, I guess. But in the money is basically where it has an intrinsic value. Buying a call option for like $3.10 when the stock is $3.11, you can exercise it right away and make $1. Of course, you probably paid like $2 for the option. If it was like expiring the next day. If it was expiring months from now, essentially you're saying, I'm gonna make money. I'm gonna pay like $400. And if it goes down, the most I'll ever lose is $400. I won't be able to lose. Let's say the stock was worth $1,000 and I paid $400 for it. I'll only ever be able to lose $400. I won't be able to lose that full $1,000. Because if I bought it at the money at $1,000, I can always buy it back at $1,000. Now, put options are basically, you're saying how long. You're basically waiting a long time and seeing if you want to buy it. So you're basically essentially freezing the price and then waiting if you want to buy it. Waiting to see if you want to buy it. So a put option, no wait, I'm really stupid, but I'm still going to upload this. Waiting if you want to sell it. A put option is basically you can sell at a certain price. So if the price is less than the price you're allowed to sell it at, then the person you're selling the put option to has to make up the difference. Of course, all the money is factored in when you buy it. But think about this. If I buy a call option at 300 and then sell a call option at 302, if that call option at 302 gets exercised by the person I sold it to at like 310, you think I have to buy an option. No, I said that wrong. Let's say I buy an option at 305 out of the money, a call option at 305 out of the money. If it goes down, I can just take the profit from, the price of the option that I sold. But if the price goes up past, okay, fucking family members. Anyway, so let's say I buy a call option out of the money at 305, and I sell a call option at the money at 300. If the stock price rises over 300, the person I sold it to is going to want to exercise their option. Let's say it goes to 303, I'm going to have to buy it for 303 and then sell it to them for 300. So I'm going to lose $3. But if it goes over 305, because I bought an option at 305, I can exercise that. So, but an option out of the money is going to be cheaper. So I might sell it for $5 and then buy one for $4. I'll make $1 guaranteed, but the most I could ever lose is $5. The difference between what I sold the option for and what I bought my option for, my call option. Because I can exercise the 305 and, I can get it for 305 no matter what price it is. If it's 310, I won't have to make up $10. I'll only ever have to make up $5. But the only time, so yeah, anywhere within the option spread, that call option spread, I'm never going to exercise my option. But essentially, mitigated risk and mitigated reward. Now the risk is always going to be higher than the reward. But that's what options are for. And that's at different strike prices. At different expiration dates, essentially what you're going to want to do is when you sell an option, when you buy an option, you're buying insurance. You're mitigating your risk. So when you sell an option, you're taking on that risk. So, and essentially when you do an option spread, The option that you're selling is the risk that you're taking on, and the option that you're buying is the risk that you're mitigating that risk. So the option that you're buying will always have to be cheaper. So you can also do an option spread at different expiration dates with the same strike price. And like I said, expiration dates that are closer are cheaper. So you're going to, let's say, sell a put option in 5 days and then buy a put option in 4 days. If you sell a put option, you don't want the price to go up. You don't want the price to go down, because you'll have to buy it from that person for a certain amount, and if it goes down, you're going to have to make up the difference when you resell that stock, or just hold on to it. So if, let's say these put options were at the money, let's say the stock price goes down, and I think it's going to stay down, I might want to exercise my put option, and the person that I sold a put option to will exercise theirs. I'll sell my 300 I'll sell my stocks for a certain price. Because the strike prices are the same, the only difference is the expiration date, they'll sell it to me for the same amount. So essentially, I was mistaken. So essentially, if you sell a put option at a 5-day expiration for 300, and then you buy a put option at a 4-day expiration for 300, if they exercise that put option to you to buy it, a put option is where you can sell at a certain price. So if they sell it to you for 300, you're going to want to exercise your put option if the stock price is down. So essentially, you buy it from them for 300 and then you sell it for 300 at the exact same time. But since your option was cheaper to buy, because it had a sooner expiration date, it's basically guaranteed profit if they exercise their option within the expiration date of the option that you bought, of the put option that you bought. Now, between the dates of 4 and 5, if your option expires while theirs is still, and then they exercise their option, then you're going to have to make up the difference. So I guess essentially you're hoping when you do a put spread that the person you're selling to will want to exercise their option before this closer expiration date that you bought your option for. Then you'll have guaranteed profit within that time range. And I'm also stupid. Where the risk is if the stock price continues to fall after your put that you bought expires, because then you're going to have to make up the difference between what you sold your put for probably you exercised at the very last second, and what they exercised their put for could be sometime in between the two expiration dates. Now, you're going to have to make up less of a difference because you bought a put option, but you sacrificed some of the money you sold your put option for. So you have limited loss. No, you don't have limited loss. You still have limited loss because you're selling a put option, but you're cutting your loss by a fraction based on the difference between the expiration dates and the volatility of the stock. Now, I can't really imagine when you'd want to do these kinds of things because, I think you're basically cutting down your potential profits and your potential and your risk by the same amount. Really, the more you complexify it, the harder it is to make better decisions by chance than someone who's smarter than you. So unless you're a genius or using a computer to choose what you sell and buy options for, the more complex you make your shit, the worse it's going to be for you. So you should just stick to simple options trading. Don't do anything crazier than a call spread. Unless you're a fucking genius, then do whatever you want and make fuck tons of money. But very, very, very few people are, and don't bet that you are. That's basically my advice. If that maybe garnished some education you did by yourself already, good. But I doubt you can understand what I just said if you don't already understand it. But that's my understanding. That's what's in my brain. I'm not gonna engage in any further. I just let professionals handle my money for a small percentage. I'm afraid of the stock market. It's honestly terrifying. I should have held Tesla. Absolutely. I'm an idiot for not. And that's why I let other people manage my money. Yeah.